Well, hello, investors and traders. I'm L.A. Little, and this is your daily NeoTA wrap. We take a look at these markets, doing it from a neoclassical perspective, a study, a model, if you will. I created it over a decade ago, used it through the crash, made money through the crash, have made money since. It consistently profits. You wrap trade management around it, put the whole package together. It's a powerful thing. I do this show 4 times a week, every Monday through Thursday. It's broadcast at before 10 o'clock Eastern Time, archived on YouTube, and it's under the channel LA Little. If you haven't subscribed and you want to, just reach up in the right-hand corner. Do so anytime I push content. You're going to get a notification. Easiest, free way to keep up with public content that I push. Here's the market. Here's the numbers. New highs, folks. Telltale sign, 0.25 on the Russell. It does a test failure at the highs. We're going to look at that. If you look elsewhere, though, it looks pretty powerful, right? 0.5% on the broad composite, 0.75% on the Dow, 0.5% on the NDX and the S&P 500. UUP, the dollar index, up. You got big moves in Germany, in France, and you had, where was the other one? Here, you had the oil down, and we're going to look at this. We had a subscriber or a member, I should say someone, I don't know exactly who, someone put a comment. If you want me to look at something, make a comment on the video. I'll take a look at it. So we'll look at oil. That's 1.62% down on that ETF. We're not going to look at the ETFs, though, because they don't track as well. Gold and silver down as well. We also had a comment about coming back to the gold chart in 2 or 3 days. We'll do that because it's set up just like an example in my book, I'm told. And we're going to look at that when we get there. Let's take a look at these charts and see what we got. Here we go. S&P pulls away. Remember last week, I'm pretty sure I said it here. I know I said it either here or to the members in general. That was on this breakout bar. We wanted to see an extension. We got it, right? An extension's great because then you can get more. That's exactly what you got today. Volume declining a little bit. We're not talking about huge volume anyway. Look at your big bars back here. This is small stuff comparatively, right? But you know, you don't try to look at it that way. You try to look at what you test and how you break. You break with volume, you get a green arrow. That says it's confirmed. It says it has a higher probability of continuance for a longer period of time, and you have the extension taking place. Nothing but good there. I can't say anything bad about the S&P. If I go to the NASDAQ, nothing to say here either. Extensions, right? Just keeps going. If you look at the NDX, extensions, they keep going. Here's the problem, the Russell. If you look at the Russell, what did the Russell do today? Test failure at the highs. What is a test failure? In neoclassical theory, in the model, what it says is if you test a high and you test it with less volume, which is what you have on this test, this volume compared to that one, if we do the numbers here, you're doing 388 compared to 334. Significant to me is less than about 1% or more. And so that had less than or more than 1% less volume, if I can get all that out. So you test fail on volume and on price. That says this thing should try to come back in. That's what you expect, right? This thing should pull back in now. If it doesn't, then the market's going to tell you something big. If it does, then it's doing what it should. Now, where should it come back to? That's always your next question. Well, you just broke over a bunch of swing point highs. Those are bullish retest regenerates now. You got one here. You got another one there, and you have another one over here. Look at the intersection of those. Where's the beefy part of that intersection? It's right in there. That's where I would think it comes to. You could get as deep as here. Well, not that deep. Let's get rid of that big bar, but right in there, right? That's where you should expect it to come back to. That's what it should do. Let's see if it does what it should do. If it doesn't, it tells us something. If it does, it also tells us something. If it breaks through all of this, then it's telling us something totally different and unexpected, and that would be very noticeable. That's the significance of the theory. The theory says, here's what to expect. Expect this, right? If you get this, that's what should happen. If this thing just turns and runs back up, that's telling you something is significant to the top side. If it just breaks all the way back through, that's telling you something significant to the downside. So you know what you're looking at, what you're measuring against, and you do it as the market evolves. And if you stay in sync here and you stay in sync on your weeklies, right, you will stay in sync with this market, and all this junk about people trying to predict what's going to happen doesn't even matter. It doesn't matter at all. What matters is you stay on the right side of the market, and when the market gets to wherever it's going to go, you're going to be there. It don't matter, folks. The news doesn't matter. All that stuff doesn't matter. Just watch what the market's telling you. Supply and demand on the charts. That's what it's all about. That's the NDX. I mean, that's the indexes, and that's where we sit on that. I want to go over and look at the gold market. Gold did something that we were talking about, and we're going to come back to this trade because this is what we were talking about. There was an example in one of my books. I believe it was in the second book, Trend Qualification and Trading. You can get it on Amazon if you really want to understand Neoclassical. Get the books, use the books to learn, come to the site, join the site, become a member. You got ABCD structures all the way up, right? And each one of these have been completing, right, and pushing higher. What do you get now? Well, on a weekly basis, this is what we were talking about, is on the weekly basis, you're actually getting the pullback. And on that pullback, as I said last week, is that you can expect this thing at this failure, right, to try and pull back. And what should it do? It should pull back and give you some sort of an ABCD structure on the way back down. The ideal spot would be back into this area, potentially as low as down here. So what does it do today? If we go look at these numbers are 115. This one down here is about 113. 116, I believe, is this bottom, 116.23. Let's go to today's chart. Where does it get to today? It gets to 116.15, back into a swing point high. What is a swing point high once broken? It is a bullish retest, regenerate. Gets into it right there, flips it around, does a little doji, lighter volume. That's like a pickaxe reversal. This thing tomorrow is going to try to push higher. This may have been it in terms of the pullback. If it is, then this market's even stronger than you think. We'll have to see if that turns out being it. But that is that trade, and we'll continue to revisit this as it unfolds because it fits in with the neoclassical theory, and it happens to mimic an example that I put in the books. Funny how that works, right? Let's go look at the oil market. There's a question there. And to look at that market, I'm going to look at the oil futures on investing.com. And the reason for it is ETFs that do trade this, OIL, USO, they're horrible about actually tracking the real market. So I don't like to look at those ETFs. We will at some point put futures on TA today. We do not have them there. So for now, we just have to go here. The problem with that, of course, is you don't have all of the structures that I have on my charts, but you can tell this is a swing point high. So is this one. Looks like neither one of those have been broken. If I go over here and look at them all, you got another one right here. It's a swing point high, and it looks like that's the only ones that are significant. Well, I take that back. 1, 2, 3, 4. No, that's it. That's it. So you haven't broken one. If you look at your swing point lows, there's one here, here, and down here, and then back over here. So you got a bunch of them. So what is all of this? Well, if I change the colors so that I can draw in here a different color, what you have is you have a range, right? And that range is basically from the lows to the highs, about that much. Until it does something above or below, it doesn't matter. I mean, it's not telling you anything. You just have a range. You had a move up, right? This all market, if you remember, came up, right? It's pushed up, doing a consolidation range. Typically what happens is they do continue with that trend. You might get some sort of a fake out down here or another push down in this area. They can't break it down. Then they take it up, right? A lot of times you try to break it down to take it up, and that may be what we end up seeing. And I should probably pull this over a little bit more so you can see these things. I'll have to redraw them now, of course, but that's what the daily chart looks like. Let's switch this thing to a weekly chart and take a look at that, see how that gives you a better view of what's actually happening. And if you look at this, That little consolidation range we were talking about is right here. You can see it. And what did it do? It came after a nice push up. So you had a big move up, right? Some retracing, another move basically up, back and forth, but finally up, and now it's up there. Now let's take and draw in what's significant here. What's significant? This is a significant anchor bar. It's got high volume, wide price spread. High volume, wide price spread anchor bars are hard to break down. They've tried and tried and tried, and they haven't been able to. That's a good thing. And the other good thing about it is here's your swing point high that it broke. So in other words, as you shot up through here, and I believe that number there, let's see, 5167, 5168. Yeah, so the close was there. So your breakout bar is this bar, right? This is your breakout bar here. You got a retest regen immediately. You got huge volume on that bar, and all of these attempts to break it down haven't had as much volume. So again, the ideal here is that eventually this is probably going to break to the upside. So without being able to play this, because the range isn't that large, what you really want to do, if anything, is you want to play that breakout when it comes and press to the top side. I would not trade the downside on this because you would actually have to get under this bullish retest regenerate. As a matter of fact, it probably is still a buy back down there depending on how it comes back. If it came back fast, furious, no volume, it's probably going to be a buy. You look for a little under over, a little hammer reversal or something, and you jump on it at a lower price, and then you can put your stops pretty tight. Right now, you don't have a trade. You're waiting on the breakout to give you that trade. That would be the ideal trade. Buy the breakout or buy this retrace if in fact it comes back down there. That's two trades that were asked about. Just want to highlight those. If you want me to highlight something, make a comment, ask me a question. I'd be more than willing to help you. That's it for tonight, folks. I believe, given what I saw on the Russell, you're going to have a little bit of pressure to the downside on the small caps. I wouldn't be surprised. And I saw also some reversals on some of those indexes inside the Russell that are big. I wouldn't be surprised tomorrow to see that weigh on the market and see the market actually start higher or get higher in the morning and then actually turn around, probably do an over-under, and we'll have to see what the volumes look like on that pullback. Have a great one. I'll see you next time. Good night.